Hello and welcome to the Virtual Business Owners Network on Friday, the 11th of July. And we're delighted to have Raymond Gibbons of BMS Accountants and a presentation called Limited or Not. Take it away, Raymond. And if everybody else goes on mute, we'd appreciate it.
Thanks very much, Alec, and good morning again to everyone. As Alec said, my name is Raymond Gibbons from BMS Accountants Limited. You can find out more about us on www.bmsaccountants.ie. And courtesy of Vincent, and a question he threw out last week was whether he should go limited or not, hence the presentation this morning. As Alex said, it is at short notice, so forgive me for typos, and if I've missed something of importance, please do contact me and let me know. We're going to look at the following areas, just very briefly: traditional business structures, why structure trumps vision, always, the need for good planning and advice, the reasons to go limited, and things that you might consider. So we know what the traditional business structures are. There are three main types that are in Ireland at the moment. Are a sole trader, it's an individual who goes into business for themselves. A partnership, where you bring more than one individual into a business. And then what we're going to be discussing today, a private limited company, which is a separate legal entity. You register it with the CRO. You have one director and one secretary minimum, and they need to be separate people, and you will put in an amount of share capital. And I mentioned that there because it's something I want to pick up on in a later slide. So, structure trumps vision. And it's not to rain on anybody's parade. We've all started out in business, or we're in business, and we have great ideas, and we wake up in the morning and we know where we want to go, or we feel we know where we want to go with the business. But all too often, we jump right in without taking time to actually just look at the structures that are required to, I suppose, enhance the chance of success, but to mitigate things if they go wrong. So it's critical that you get the correct structure in place for your business. My father said to me many years ago, when I took a school out on strike in Finglas, and he let me go ahead with the decision. It didn't go too well. And he said, maybe next time you'll think twice about your decisions. So we measure twice and we cut once. So look at the nature of your business. Are you dealing domestically, or are you going to be looking to deal on an international basis? So it's important, because if it's an international trade, it's going to bring on other sorts of criteria for your business. Are you going to look to expand, or are you going to keep your business locally in your own area? Will you have a need for investors or to raise additional capital? So as a sole trader or a small business, your stakeholders are really yourself, the revenue commissioners who you pay tax to, the banks, and your spouse is probably or your partner is the next highest up on that rank. You will have suppliers and customers, of course, and you will have, if you have employees, and your local community. They're the normal stakeholders for a business. As your business grows, if you become limited, you take on additional stakeholders. It could be additional investors. It'll be other government agencies such as the CRO, and it'll be other lenders, etc. So the stakeholders grow as your business grows. What I see with businesses who are set up poorly is that they tend to have poor structures in place. They get poor advice, it leads to poor structures. And I mentioned share capital, and I just want to give two examples of that we've come across where we found that businesses set up incorrectly by people not taking the correct advice. A number of years ago, we came across a business, and we're still helping them out. And he'd set up his business, and a friend of his who was in business gave him the advice of investing all of his money into share capital in the business. So he put tens of thousands into the share capital of the business. And he came to us asking us, how can I get that money back out of the business, because I want to put down a deposit for a home? Well, he couldn't unless he incurred a lot of capital gains tax issues. And we won't go into that. But the point was that if he had been speaking to an accountant or somebody else who had said to help him set up this business, he would have put that money in as a loan to the company in his director's loan account. And when there were funds in the business available later on, he could have taken that loan, repaid himself that loan from the business tax-free. No issues with getting it out. By putting his money into share capital, he created a bigger issue for himself with trying to get that money back out of the business and avoid tax. Also, we've come across small business structures where they've set up group accounts for whatever reason. So they'll have their own limited company, and someone will have said, well, why don't you set up a parent company? Because if you ever go to sell this business years down the road, and that's all well and good, but you need to look at what you need now. Don't be jumping the gun about planning is excellent, and you need to plan accordingly. But simple structures are best for your business in the early days, particularly when you're setting out. Other things that we find is that in partnerships, there's no exit strategy, or there's no plan for if there's falling out between members of the business. We tend to go into business with rose-tinted glasses, that we go into business with friends or family, and we say, well, we've always been friends and we've never had a falling out. But you've never been in business with somebody. And where I want to go with the business might be different where Alec might want to go with the business if he was my business partner. And how do we resolve that dispute? So you need to have good structures in place to make sure that your business has the best chance of success. So when you've got your great idea and you know where you want to go, pause, take a breath, reconsider, ask yourself the whys, the whats, and then jump in and have fun growing your business. Majority of times we find that a sole trader or simple company structure is more than sufficient for the average business. It's important to make your business easy to operate and run, that you get good planning and advice. So in your back pocket, you should have an accountant and a solicitor, and you speak to these people at all times. That's what they're there for, to help you out and help you manage your business. Speak to other business owners. It's all well and good speaking to friends and family who tell you what you want to hear over a dinner table. Sure, Raymond, you're great. This will work out brilliantly. There won't be any issues here, and you're going to make this business a success. Join your local chamber and speak to other business owners who've encountered the same difficulties that you will. Cash flow, employing staff, acquiring loans, acquiring personal loans, all these type of things. Have good, clear objectives and visions for your business. But again, keep it simple. You focus on running your business and making it profitable, and take the advice on how to set up your business from those that might just be more experienced in that area. And again, always ask yourself, why am I doing this? What are the consequences of setting up a limited company further down the road? What if I want to wind this company up? How difficult will it be? What if I want to bring in a partner? So the reasons to go limited, and this is the main one for many people when we sit across the table from them, is they talk about taxation. Income tax, the higher rate is 40%, and that's before we discuss USC and PRSI. Versus corporation tax, 12.5%. So it seems like a no-brainer straight off, saying, my God, I'm paying 40% on my income tax, and if I was a limited company, I'm going to pay 12.5% corporation tax. But if you're a sole trader, and I think Rory might back me up here, that what we tend to find with the majority of sole traders is their drawings tend to deplete their bank account. So what I mean by this is you could have a sole trader operation and its earnings, it's showing profits of 60,000 euros in a year. And yes, you get taxed on that as a sole trader. But you might be withdrawing 60,000 euros from the business for your lifestyle, to pay for your mortgage, to pay for your car, whatever it is. So you may be taking all of the profits out of that business. So if you were to convert to a limited company, there's no benefit there, because you're still going to be taking out 60,000 euros that you're going to be getting taxed on, except through the payroll. So the first thing we look at is that when a sole trader's profits exceed the cash being withdrawn, then it's maybe time to consider alternatives. So let's say you are making 60,000 euros profits as a sole trader, and you're only taking out 30,000 or 35,000 euros. That's all you need to live on. There's extra funds left in that business that are being unnecessarily taxed, let's say at the higher rate, once you go over 44,000 euros. But the first thing I'd look at is when I'm talking to a client and say, well, before we have a limited company, are there other options to reduce that profit? And one of the ones that is common enough is that you might hire your spouse. So if you have a partner who's at home, can they do work for you from an administrative perspective? Can they help you with marketing? Is there something they can do that you can justify a salary that will help reduce the taxable profit for you as a sole trader? If not, and your profits do exceed the cash that is you're taking out of the business, and you feel a limited company is for you, well, go to the go to your accountants and discuss it with them, and let them help you set up the limited company. Company directors are taxed only on the salary from the company. So what you take out, just like another employee, you get taxed on, and the remainder is left and taxed at 12.5%. There's no employer PRSI on director salary payments. And I mentioned this because this is another area that we find when people set up their own companies and they go online and say, well, I'm going to do my own payroll because it's only me, there might be my wife or my husband, and there might be one other employee. And I'm going to run my own payroll because I've seen how to do this online. And they set up the directors with an incorrect PRSI class. Because as a director of a company, your PRSI class is S1, which means that you don't pay employer PRSI on director salaries. So if you employ staff, you pay employers PRSI. But if you're a director of a company, your salary does not get taxed by employers PRSI. We picked up a client last year, and they had set up their company, and they'd gone to a bookkeeper to do it, and they'd set up their payroll, and all the directors had been paying, or employers PRSI had been charged on all of the directors' salaries for over 4 years. Well, we went back as far as we could, talking to the Department of Social Welfare, and we got a sizable refund back for the clients, for the company, because we were able to get the PRSI refunded to the company. They were delighted, and we were delighted with the nice fee that we got from finding that as well. And it was all because the structures and the setup were incorrect at the very beginning. So why else? Pension and expenses. Companies can make generous pension contributions to director pensions that are tax deductible. So you might look and say, well, I'm too young for a pension. It'll be a lot, but years go by very quickly. So you have excess profits in your limited company. Still, the best way of extracting any cash from business future down the road, or further down the road, is through your pension. And the older you get, one of the real advantages, because there's not many, is that the company can make larger pension contributions to your own pension scheme. You can claim mileage, subsistence, travel expenses as a director. You can also claim the small benefit exemption, which is 1,500 euros of gift vouchers that can be taken out once a year. Something else to note here, if you're doing your own payrolls, if you're taking out mileage, subsistence and travel and paying yourself the voucher, you need to be declaring those on your payslip as well. They are non-taxable, but revenue needs to be updated as you take them out on a weekly or monthly basis. Other reasons to go limited. Business expansion, of course, because you could be, if you're got a service or product, and it might be that you see a great growth or potential for growth, you might want to court Enterprise Ireland, for example, which would be common enough that we, again, with small businesses, they want to engage with whether it's a local enterprise office and move on then to Enterprise Ireland, and a limited company is the format that they're looking for. You might want to be introducing new partners, and a lot of people see it as enhancing the reputation of their business to be limited. So limited liability, it's not as big an issue as it made out to be, because again, we get people sitting across from us and saying, well, I've limited liability, I can take out loans, I can have debts, and if the company folds, nobody comes after me, right? And you go, well, that's wrong. Because if you take out a loan from the Bank of Ireland as a company, so I'm BMS Accountants, and I want to go on an expansion drive, and I go down and secure a loan through Bank of Ireland, they're going to make me, Raymond Gibbons, sign over a personal guarantee, so that if my company folds, the bank are going to come after me directly for my for repayment of that loan. So you don't have that limited liability there. So things to consider. Setup and costs. Again, the very first thing, speak to an accountant. Keep the structure simple so that you can focus on doing what you do well, selling widgets or whatever it is that you do. Remember that transferring of assets from a sole trader to a limited company, if it's not done correctly, can trigger capital gains tax. And that's a topic that Rory might be more even better versed or educated than me to go through, because it's something that even we might at times, when we have a client who wants to convert over to a limited company or revise their structure, we may even go and ask another accountant their advice to make sure that it's been done correctly. Use the director's loan account or current account. Because again, if you're putting money into your business, don't put it in a share capital. Put the minimum amount in a share capital. Put it in as a loan to the company so that you can actually extract that cash out of the company tax-free when the funds are available. Do expect additional fees. You'll see online, it'll say, we'll set up this company for 199 euros plus VAT or whatever. But by the time you go through the whole process, you'll find that there's extra fees for registering you with the CRO, registering you, filing the first B1, registering the company with revenue for all tax headers, etc. You're also going to have to go talk to an accountant, in my view, so there'll be a consultancy fee for that as well. So maybe you should be budgeting at about 700 euros to set up a company. There will be additional accounting fees for producing annual accounts and corporation tax returns. As I said to you earlier, to the sole trader, the main purpose for producing your accounts is for you and for the revenue commissioner so that they know your tax liability. When we come to producing accounts for a limited company, we're filing those accounts with the company's registration office on your behalf. We're preparing and filing your B1, your corporation tax return. So do expect to have much greater fees for preparing limited company accounts than you will for having just sole trader accounts produced. Compliance is another issue. Your annual returns must be filed on time. And I'm going to pause there. I just made a note. I was just Googling around yesterday, getting prepared, and just a couple of things came across that I thought was interesting. In Ireland, there are 392,000 active businesses according to the CSO in 2022. Of those, there's 180,000 that are active companies. And of those, there's 92% that employ less than 10 employees. And out of the 180,000, there are only 700, or it was actually less, 684, I think it was, 700 we'll round it up to, large companies that require auditing, would you believe, technically. Because when we sit across and we talk to business owners, and let's say we have a new client coming in who operates a limited company, they say, oh, our accounts are audited. And more often than not, we find that they're unaudited, and the client didn't even know that, because they're assuming all accounts are audited. Now, if your company doesn't turn over 15 million a year, or doesn't have a balance sheet worth 7.5 million, or you don't have more than 50 employees, you don't have to be audited unless it's for you may have not filed your accounts on time, which means you've lost your audit exemption, which means your accounts have to be audited for 2 direct years after. But most companies in Ireland don't require auditing, and we don't do auditing here in BMS Accountants. We don't get involved in that area at all. We just deal with unaudited company accounts, and that's because over 90% of the business in this country don't require auditing. So there's plenty of business out there for us. But more often than not, we're talking to clients who've set up limited companies who don't understand the difference between audited and unaudited accounts, and the reasons why you can avail of audit exemption. Again, finally, one director, one secretary, they both need to be different people. And then just one thing to note, when you set up a limited company, there's information available to the public via the company's registration office and the RBO now. That means that for €2.50, I can go into the CRO and download a set of accounts for any company in Ireland, find out who the directors are, and then I can do a director's search on those using the likes of VisionNet. So when you have a limited company, a lot more information is out in the public domain. Other reasons, additional tax returns to consider. Other additional tax returns for the company to revenue, corporation tax, for example. If you have staff and you're in a sole trader operation and you're transferring those staff to the new company, you have to do it correctly to ensure there's continuity of employment that protects their employment rights. Setting up a company, we would like to see more robust administration anyway, but it would be better if you had a more robust administration, regardless of whether you're a sole trader or a limited company. But you do need to see improved record keeping and better quality accounts. Some people find that succession planning may be easier. A company has a life of its own. It can be more difficult to wind up. But if you're stepping back and you have family members who are taking over running the business, the limited company just keeps on going because it's its own entity. Alec, that's pretty much it. It was a quick run through. It was short notice. Thank you all for listening. And I'm Raymond Gibbons from BMS Accountants.
Thank you very much, Raymond, for a very informative and concise presentation.
You're welcome.